Good evening, reader, and Oak Bloke here, and this is going to be covering diversified energy. So, I think we all know that diversified energy has been going whoop, um, and it's been doing that since the Maverick deal. I think it's fair to say. So, if we went and looked at let's do a year to date. So, it's this point here, isn't it? February the 16th. And if we look at the news flow, well, I think it's fair to say that the news flow was shortly after. So it's, February the 11th was, I think that was a Tuesday, if I'm not mistaken. And sorry, let me just grab my calendar. Let me put that back up on screen. Too many windows open. So yeah, few days later, the price fell. Um, I suppose 2 days after or is it a few more days? Few more days after that price fall, an announcement was made about a fundraising. So this, in fact, let's just grab this and let's just sort of look at the sequence of events if we can. So yeah, let's look at the news flow dates and what happened when. So we can see, um, yeah, trading update the 11th, very positive. Proposed offering of shares 19th, very negative. So the sort of sequence seems to be that the thing that's triggered off this share price fall. I don't know why this doesn't sort of contain all the proper news, but it's a bit annoying. Let's try it from this one instead. So if we went and looked at news flow, so that February 16th, yeah, again, just doesn't really give us any proper information. I imagine the SEC filings are just as bad, yeah. But yeah, look, it roughly tallies in with Maverick. I suppose the concern by some people being that, well, A, is Maverick too big a fish to swallow? B, you've had to go and raise some equity as part of the fundraising to afford Maverick, which, by the way, is not actually unheard of or uncommon that um, that debt investors or people that are going to offer debt ask for a greater participation of equity holders. It's not unheard of at all. So that in itself is not necessarily altogether a negative, but that's what's kind of caused it. Very interesting, even like what is it, the sixth today, uh, even in the last few days, and this is post the news that shorters are reducing their shorts. So that tells you something, I think. And let's kind of go back a gear, because let's go back to the start of the year. Let's take a breath, go back to the start of the year. So what's happened to diversified energy? Let's kind of walk through the sequence of events. So small acquisition early in the year, January the 6th. This is Summit. This is my article, excuse me, that covers it. And hopefully what I'm doing here is talking through my version of events, and hopefully just presentation of facts, as to as a shareholder, as somebody that's decided to average down on diversified energy, um, why I've done so and my reasons for doing so, and appreciate that um, everyone's different and everyone has their own view, but I think it's a great opportunity, and this is this video hopefully conveys why. Anyway, so um, what was Summit all about? Well, Summit was one of a number of deals, and these go back to 2024 really, but we can see and what I've set out in this chart is there was so historically there was a participation with an organization called Oaktree. Oaktree went in 50-50 more or less roughly with Diversified with DEC to fund a number of purchases going back to 2021, 22, 23. So Oaktree, for whatever reason, decided to part company with Diversified, and this was essentially DEC buying them out because they had right of first refusal. And of course, the logic of buying them out was that it made perfect sense. Um, it it was assets they were already looking after. It was assets they knew. It was assets that perhaps they'd not optimized, because obviously you're potentially optimizing something where you're only getting half the upside, not 100% of the upside. So anyway, I looked at the numbers. I looked at the acquisition price, 307 million. How many barrels of oil a day? Just over 20,000 BOE. How much of that was gas and how much was liquids? Then kind of made a judgment call on sort of, and obviously 60s well below, and that's obviously NGLs and oil, but 60s kind of not, it's not an aggressive number, let's put it that way. Certainly wasn't in 2024, and not when I wrote the article. I think oil's come off a little bit during the past 2 months, and then $21 per barrel of oil equivalent, which, I mean, if we go and look at so 429, if you multiply that out by 6.02, basically you get to something where that number is dramatically wrong. So these prices, and therefore the estimates of revenue, I mean, this is on the low side now, and obviously DEC are not going to get 100% of that upside because they've got hedges, so it's about roughly 80% hedged. So you're only seeing 20% of any upside above that hedge price, and the hedge price is about, I'd like to say, about 342, which would then be, obviously again times that by 6. That comes out at about $20.60, something like, not far off that price there. So with actual prices being above that, there's only going to be 20% of the upside of that price because of the hedges. Okay, so I'm not saying that this, because this is now sort of 15% higher in reality, that this number here is 15% higher, but it is higher. So the income from this is higher, and that applies across the board to all of these. Again, you can sort of take these revenue numbers and probably apply, 3%, 4%, which obviously goes straight to the bottom line. There's no costs associated, well, apart from tax. I mean, take off 22% tax, and you're still looking at an upside. So the incremental profits here and these ROIs, we're all of these were profitable deals. They were all accretive, as in, even after, what I'm doing here is basically saying, well, let's take the revenue number based upon these assumptions here. Let's take off a $10.10 BOE number, which I think actually it ended up being a touch higher. So if we go and look at the results here, 10.22. So it's gone up a little bit. So the margin is slightly lower. Just trying to be fair here and sort of give you the facts. So yeah, 10.20 minus from I think this 28.80 is the sort of blended, so there's a sort of a margin of 18.70 in this model, what I'm saying is 1860 plus 3% on this, which is about 70 cents. So net, it's about 60 cents higher than this value here, okay? Which drops down then to obviously this EBITDA number then. We're looking at 138 on Oak Tree, for example. Then what I did was I said, well, the cost of interest, and I think I put this at so obviously it's on this number here. I tried to use the cost of debt, and I think I used the blended average there, 7.3, I think it is. Then took off tax at 22%. Again, I'm just sort of using a across the board number to give myself a number of what the net earnings were. So this is kind of uh, EBIT, and then taking off the depletion gets me to kind of, well, net of all of these costs, we're looking at 66 million return, even after paying the cost of the leverage or the interest on the debt that you're taking on. That 307 obviously is going to cost you 22 million a year to borrow 307. So even after even after taking into account costs, and as I say, that number, I think we could arguably take that to a bit higher than 65, maybe closer to 70 with today's gas prices, even after hedges. And the same here with these. I mean, they were all net profitable, okay, including Summit. There's a incremental net profit. Now, the other thing I would say is that these numbers were based on historical production, so they don't take into account any synergies, any workovers, any optimization, any coal mine methane in the case of Summit. So, and do talk about that. This 9.7, 969, 9.7 is before any upside from coal mine methane production. Because this is the thing, you you earn the taxes, the credits, tax credits, but you also get, if you're piping out methane gas out of a coal mine, I mean, you're dealing with a safety issue there, uh, but that's stuff that you can put in your own pipes and sell it to somebody. Whereas historically these coal mines have vented it to the air, and the methane goes up into the atmosphere, causes carnage and global warming and climate change, and shows up when satellites go over that track methane, and Bloomberg article writers that want to kind of criticize we've seen past articles where people have criticized the emissions of methane. So this is the whole point of these tax credits, is that it tackles that problem, and incentivizes people to tackle that problem, importantly. So no upside of that, no upside of that. And I mean, we could be looking at I mean, certainly it's eight figures, $10 million plus. There's definitely upside. The other thing that the 9.7 didn't take into account is obviously Summit's wells and DEC's wells. So Summit's wells are these ones here, DEC's wells are these ones here. They're on top of each other. So I mean, that's about as synergistic as you can get. That obviously you'll have well hands that can kind of take on the Summit wells as part of their rounds and all of those good things. Obviously, you know these guys possibly were paying for midstream pipeline, and now they're not, because they can just pick up and use the deck pipe. It's all of that fun stuff. Okay. Smarter asset management. I mean, DEC have proven this over its past acquisitions, that it can achieve that. And if you read this article, 2024 results, um, you know, there's proof of it even in 2024, in the 2024 results, that my model based upon depletion was that we were going to end up at 137 thousand barrels per day. We ended up at 144. So in other words, you know, I kind of deliberately didn't sort of assume that there'd be synergies, da 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 da. I just say that this is kind of before any synergies, but this is what the model says. And when I talk about the model, I'm talking about this one, that if you've watched any of my past videos or read any of my past articles, this model is not new to you. You've seen it before. And basically what I'm doing here, I mean, just to kind of explain the model, is I'm taking a depletion rate of about 10%. So it's 66.5 over 68, which when you compound that over 4 periods, you get not far off 10%. It's not quite, I'd say it's probably 9.78, 9.7, something like that. But, to me, that's kind of quite closely, because obviously I do the model, see the results, revise the model. So that's kind of, I'm pretty happy with that. And these pluses are obviously when there's acquisitions that the numbers change, that the production increases. So this one here, as you can probably tell, is the Maverick, and so on. So anyway, that's kind of explaining the model. I mean, look at my model as well. I mean, obviously I've got in here, I think I made this change based upon the prices going up, but I'm modeling at $24, which is what today's price was. And we can see that even after taking into consideration interest, that obviously interest is rising, depreciation, everything, we're coming out with net profits. So the models worked, other than I'm not assuming these kinds of synergy upsides and outperformance, but I kind of thought it would happen. It's happened before. I believe it will happen again. So this is kind of why I say, like, when I say this is before this, and this, I mean, I'm not sort of, I'm not sort of like somebody on one of these chat room things in the chatosphere was saying, oh, well, the Oak Bloke says the free cash flow is going to go down. And I did. That's the fact. Again, let's kind of get that up on screen. So let's kind of tackle what oh gosh, I've got so many things here. Hang on. It was this one, Maverick. So I think they were referring to this. Cash flow drops 2%. Yes, that's what the numbers say. However, however, do bear in mind, because this is quite an important point. Do bear in mind, I'm basing these numbers are all based upon the 30th September 2023 to the 30th September 2024. Okay, nothing other than that. No synergy, no workovers, no, optimization, which we know is happening and has been happening and will happen. The other thing I would point out, with respect, is free cash flow is 125 million, quite low compared to diversified, where it's double. Why is that? Well, Maverick do a lot of drilling. DEC don't drill. They never drill. They say, that's not for us. That's not our strategy. We don't do it. Now, obviously, Maverick have got their joint venture, and the joint venture is that the other party is exploring, doing E&P. That's fine. That's kind of now part of the diversified business model. However, the real number you need to be looking at here, with respect, is the operating cash flow. Why? Well, I think it's obvious, but let's kind of get into that. And sorry, let me just grab where is my operating cash flow? I do have it. And I'm trying to think where I have it. It's I did it on this one for J2. Yeah, so actually it was quite funny. One of my readers contacted me and said, I've basically done a load of calculations and worked out that the free cash flow per share has been dwindling. And these were their calculations. So I think the numbers, so this is 2020, and we can see, yes, here we go. Sorry, yeah, I'm just getting my head back into it. So they said, well, if you go back to 2020, the free cash flow per share was almost 7p. Whereas if you look at, I don't think this number was available, but this was the, I think, estimated. No, actually, no, it was available. Yeah, they sent me this question um, after the trading update. So obviously we haven't had the audited accounts for 24. They're imminent, which, by the way, I think is going to be a very bullish event, but more on that later. This is the trading update. So look, you know your free cash flow has dropped by a third. I'm very worried about this. What do you think? And then as well, the debt per share has been going up and up and up. What do you think? You know, these are all negative things. And then I think what they were doing, yeah. So essentially, basically saying, well, if you take that ratio, like, you know, per share, each shareholder owes $20.47 and is earning $6.98. So the ratio is 2.93, but the ratio has deteriorated where if you take the free cash flow compared to the debt per share, like the debt has increased by 2.5 times. That's dreadful. So what I did was I said, well, look, okay, you know, like those are your numbers, and in fact, it's coming back to me now. I was on holiday at the time, and I said, well, look, and I think they sent it to me, and then they chased me, and I said, well, look, with the greatest respect, I'm on holiday. I've got a smartphone with me. I'm not going to try to do justice to this without having a desktop computer. So bear with me. You know, I'm back from holiday on the following weekend. I'll have a look at your numbers and come back to you. Anyway, um, I did do this when I got back, after I got back. Um, and I ran my own numbers here and I said, well, you know, let's kind of look at what you know the annual reports say. And again, this is, you know, what I'm doing here is I'm just taking the numbers. This I think is the September number that I took, and then this is the, you know, the 125. So that's kind of the 345 post Mav is post Maverick, obviously. Um, yeah, and then I sort of took the weighted shares, because obviously the trouble is that the debt per share is changing and the free cash flow per share is changing because the number of shares is changing. You know that obviously here equity was raised, and obviously quite a lot of this is uh, Rusty as part of a deal rather than saying, you know, I'm going to give you X million or X billion dollars. You know, I'm going to give you this much cash and I'm going to give you this many shares. So, you know, all of these acquisitions that we were chatting through have been a mixture of cash and shares, and so it's not and debt, you know, so it's not just all being one thing. So anyway, to do it fairly, you've got to obviously take the number of shares to work out. So I did my own calculation and then I sort of put the two lots of numbers together so I could sort of see what was going on. And you know, my numbers weren't identical to J2's calculations, but not far off. I think, you know, I disagreed on the post Maverick. I came out at 5 pence, 5.05 pence, um, $5.05. Sorry, let me get this right, per share, whereas they thought $4.70. So I'm not sure how they arrived at $4.70. I arrived at a different number, and I think what I was doing there was taking that number there, the 345 million, which was obviously what was on the RNS, and then that by the number of weighted shares, you know, so that's kind of post Maverick. This is how many shares are going to be an issue to get to that number there. So you can see, I think that's a entirely fair calculation. I'm not sure what this calculation was, but anyway, doesn't matter. What I thought was really important though was the operating cash flow, because what's the you know, it's going back to my rhetorical question to you, hopefully rhetorical. What's the difference between operating cash flow and free cash flow? Well, capex mainly. I mean, you can sort of put other bits and pieces in there, but mainly it's capex. Okay, so how much you're investing in back into your business, um, on the basis that, you know, with depreciation and obviously cash flow doesn't take account for depreciation. So if we're talking about sustaining capital or replacement capital, then free cash flow is a better judge of that, because obviously, if you're having to replace things that have worn out to keep the thing going, um, judging it on operating cash flows, not not taking into account any of that, is it? So, um, and in Diversified's case, I mean, obviously you've got the depletion to think about. You've obviously got replacement. But capex historically, when you look back, isn't that high. The thing that kind of makes that free cash flow number much lower, and this is kind of the proof of the pudding, really, is that like the difference between DEC pre-Maverick and post-Maverick is nearly 280 million dollars. So in other words, this increase here of 120 million, well, that's because 160 million is being stuck into a drill bit, presumably. I mean, obviously, we don't have any detailed knowledge of what Maverick are spending 160 million on, but I suspect it's drilling into the ground, which obviously DEC will have a view on, and they'll own Maverick and whether they'll keep spending. So in other words, when you look at operating cash flow, um, which obviously, when we look at this, I mean, actually, this is probably a better way of talking about it. The difference there is what, 50 million? The difference there is 100. So there's some degree where operating cash flow, or sorry, free cash flow, yes, the headline number is 345 before any synergies. Yeah, any synergies. That's, and it's historical, doesn't include Summit, doesn't include workovers or different things, doesn't include today's gas price, importantly. September 23 to September 24. Let's think about this. Let's do this. Let's go back over 2 years. I don't think I can. I have to go 5 years. But I mean, we're talking of like, the gas price that was this point here. Look, $2.56. To this point, well, you get the idea. Here, $2.48, and then in between, I mean, yes, there was a tiny Christmas or November pre-Christmas, Thanksgiving spike. If you can call $3.77 a spike, mini spike at best. Yeah, so pretty much the median pricing for that free cash flow estimate is pretty low. Come on, like you've got to say that's sort of not far off. Well, in fact, we can say here, can't we? Looking at this, average prices in 2024 were 321 inclusive of hedges, 321, $19 a barrel. Whereas today we're looking at what, 25% more? 25% more. So if you said, well, okay, fair enough, like we've got to take at least 25% on top of that number there before synergies, remember, before Summit, remember, um, and then sort of, let's also say, well, there's another 100 million potentially of capex that may or may not be spent going forwards. I mean, 2% down very quickly disappears into something that's a lot higher than what it was before. So the argument that somebody made about, even the Oak Bloke says that cash flows going down wherever they said it, who knows? Yeah, that come on, you've got to sort of look at this probably in a more balanced way, and just read the rest of the article. Come on, because actually when you sort of see the cash flow is down, that that the, as I say here, the long-term picture on cash flow is far more positive. That yes, there are some short-term aspects, the accelerated repayment to Oaktree, and again, let's look at this sort of logically. Uh, the accelerated payments to Oak Tree, which is this one here, which sort of is due to end here. So in uh, 15 months time. Yeah, okay. Um, Once this is gone, I mean, this is the most, well, apart from this ABS and the RCF, I mean, this is the third most expensive form of debt. This RCF, now they might roll the RCF, they might refinance it, they might do, obviously a big chunk of it. Sorry, let me just get this full screen. Yeah, so this was the RCF before the announcement of the refinance. So I had sort of thought to sort of plod through these articles one by one, but I'm jumping around a bit here. But hopefully you get the idea that what I'm trying to do is build a picture here for you to sort of say, well, you're looking at like one bit of the picture, um, but you've got to look at the whole thing really to kind of get a balanced view. At least I think so. So in this article here, where we talked about ABS 10, ABSX, no connection to Musk. Yeah, so the implication was that there was this what I described as the red cliff, or the cliff edge that was flashing red. I think I called it. Was that this RCF is due to expire at the end. Sorry, mid 26. So on the basis that that needs to amortize between when this was written, and the end the end of H1 26. I mean, those are the sort of levels of amortization or repayment. When I say amortization, I mean repayment of the capital. So this is the repayment of the debt capital, the amount that you've borrowed, or the amount that Diversified have borrowed. You haven't borrowed it, but your invested company has. And then this was essentially taking interest rate and that amount owed. Obviously, it is crude because I'm just doing a 6 month to 6 month calculation and saying, well, if they owe, if they're repaying 15 million and they owed 71, well, the rest of it, so that calculation there is basically, I mean, it looks horrific, but all I'm doing is I'm just sort of saying, like, we're only paying interest on what we still owe, and I'm sort of doing it in 6 monthly chunks. So it's crude, but you get the idea, and it's roughly correct. But the idea is that that's how much interest is being charged, which obviously, this. And this is pre-Maverick, by the way. That's the other thing to say here, that this is just the debt, because obviously the Maverick deal hasn't closed. It's going to close in the next few months, but it hasn't closed yet. As it stands, there's 107 million of interest in the, and I did this in sort of half year to half year. I think mainly because I'm trying to think now why I did. Mainly because it was sort of, I think, how or maybe I did it on the back of the interim results in 24. So anyway, that's why I did do it that way. But we're talking like 53 million per 6 months. And in this current half year, we're talking of 53 million. But that drop. I mean, obviously pre-Maverick, that drops down, 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 down. Okay, over the next few years. So free cash flow. I mean, just sort of, in terms of uses of free cash flow, obviously the call upon the free cash flow to pay interest charges drops year by year. But crucially, when your operating cash flows, um, going to more than cover that. That then and anyway, that was the sort of old picture. Sorry, let me just move on, because what's happened is the RCF has been largely paid down. That what they said is that they're the refinance. So what I did was I took the ABS amount here, which was the 530 that was borrowed. They told us that they paid off ABS 1 and 2, so they're gone. They told us they paid off the term loan, so that's gone. and refinanced it at 6.4. And now we don't know the maturity of it, but I've assumed a 10-year amortization schedule. I mean, that again just seemed reasonable to do. And then anyway, these are the interest charges. So we see, we're still looking at the same here, and then it obviously jumps a bit here, but we can see this sort of largely, it gets rid of the cliff edge. So again, these amortizations and these interest payments are achievable, and as I say, it becomes progressively um, more affordable as time goes on, as debt expires. Now obviously things could change, more acquisitions could happen, refinancing could happen, so it's not to say this is a definitive picture, but the point being is that this kind of leaves things affordable. Certainly, um, yeah, certainly um, proportionate. Is proportionate, that I don't see that, having sort of analysed it, I don't see that there's a cliff edge now. And I mean, that was always my point about the cliff edge, that there is a cliff edge, but presumably they're going to refinance and will need to refinance in order to avoid that cliff edge. And then of course they have, and the cliff edge was end of 26. So avoided it with some room for maneuver. Okay, well, anyway, that sort of addresses the concern about cash flow, concern about yeah, I suppose let's kind of think about, well, why is the share price dropping? So somebody else said about tariffs and how that's going to affect things. Well, yeah, it's interesting. I mean, obviously, it does change the dynamic. There's a lot going on with dynamics changing. That's true. However, couple of things. Number one, I mean, Trump is obviously doing the tariffs in tandem with tax cuts. So tax cuts are going to be stimulative to the US economy. Um, More than anything else, I think the reaction to tariffs has been, we're going to move. And in fact, on Bloomberg this morning, there was oh, Royal, I think it was an analyst, no, it was a global equity analyst for Royal London, and talking about different markets, and talked about how the European market is cheap, but her point was that a lot of companies are going to be making the decision to expand into the US and to build production into the US. So she was actually saying, this is going to be net negative for Europe, because um, companies are going to be looking to reshore production into the US in order to avoid tariffs. So I think that, combined with obviously the political pressure to one of the ways around tariffs is to essentially buy enough from America that you're not a net. Um, your balance of payments with America is not vastly in your favor versus America. In other words, you don't run a huge. If you run a what am I trying to say here? If you run a large trade surplus with the USA, it's highly advisable to buy more stuff from the USA in order to equal out that surplus. So, what's one of the easiest ways to equal out that surplus? Now, a couple of ways of doing it. I mean, one would be um, something easy like precious metals. If I import a lot of gold from America, that 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 would settle any trade surplus very quickly. Now, how practical that is another matter. Another way to equal out, and what do most countries need right now? I mean, Europe, Asia, is energy. So, and specifically LNG. So, when people say that they're worried about diversified because of tariffs, I just don't see it. I see quite the opposite actually, where um, we know that LNG export facilities are, they're absolutely doubling down on the expansion of those now. There's no two ways about it. Um, the tariffs on Canada suddenly mean that Canadian gas, I mean, it's bad for the Canadians. I'm not saying it's equitable, but the fact is that diversified are no longer in the Appalachian competing with cheap Canadian gas, because Canadian gas is cheap. If you look at the AECO pricing, it's even lower than Henry Hub, and much lower actually. And so yeah, there's that aspect. Um, I think there's a lot more industry relocating into the US. That's going to need energy and more energy. Obviously, the whole tech thing is still just exploding. I mean, looking at Nvidia's results, was it last week? I think it was last week. Yeah, it was last week. Week ago today, actually. Or yeah, I think it was a week ago today, or maybe 8 days ago. Anyway, whenever it was, very, very positive, growing very, very fast. I mean, the rest of the Mag 7 growing very, very fast. Data centers growing very, very fast. All of that needs energy, and I think to sort of think that the US, I mean, yes, could there be some sort of recession possibly, but will diversify get caught up in that? I I think it's actually a very defensive play, because I think I would be very dubious that that line of thinking, that's gonna that we're somehow going to see some sort of decline. I mean, will we see inflation? Yes, quite possibly. I think inflation's quite likely actually, because of tariffs and because of different because it just throws things into disarray. It messes up supplies once again, and the inflation we saw in 23 was largely, it was the Red Sea getting blocked up. It was, the whole sort of disruption post COVID. It was, the dislocation of demand and supply. All of that's happening again. So I'd be gobsmacked if we don't see vast amounts of inflation. But will we see reductions of demand for natural gas? Absolutely not. I think that's not going to happen. And will we see reductions in demand for LNG? Absolutely not, because that's actually a net beneficiary of tariffs, as far as I can see. So look, I think that the share price fall, for whatever reason, is an opportunity, not a reason to worry. Is kind of how I see it. Um, I yeah, I guess, looking at every metric that I can, free cash flow, operating cash flow, the synergies, the value of the acquisitions, how that obviously costs are still under control. That gas prices are obviously in a much happier place. When we look at, I mean, when I saw this just absolutely made me think, like, wow, like we now have gone from being consistently, I mean, that dotted line is the maximum average of 5 years, the lower dotted average of 5 years, and we've gone from being above maximum, okay, last year, for most of last year. Obviously, here, late last year, we fell down because a number of natural gas producers shut in production and said, we're actually going to. I mean, apart from this sort of slight below average here in October, uh, we hit the upper maximum here, but now we've gone from the upper maximum to the lower minimum. virtually. I mean, I think we're a shade above here. There we go. You can see it there. 100, 118 billion cubic feet. 118 billion cubic feet. But what we can, and I sort of earlier, this was an earlier article, but it was starting to happen there, and I talked about it. But this, obviously the price has gone from $4 now to 4.30. But we can see like this diagram here, which is from I think it's from the EIA as well. The growth in supply. I mean, let's look at these numbers. The growth in supply in 2025 is going to be 4.2 BCF BCFPD, billions of cubic feet per day. 4.2 growth. The increase in demand forecast for 2025 is 5.1. So let's think about this, folks. 140 above the minimum, 140, but we're saying 0.9 per day. Okay. So let's just sort of do a little bit of mathematics here. Okay. 140 above the minimum. Okay. Outstripped by 0.9 per day. So in 155 days, we're going to be below the minimum. So obviously 5 months, we're going to be below the minimum. Now, obviously there's a lot of variables behind this. What about 2026? Well, 2026, growth in supply, 4.3, growth in demand, 4.8, 0.5 per day. So let's think about this some more, right? So 155 days, there's 365 days in a year, isn't there? So 210 days at 0.9. So we're going to be 189 billion cubic feet below the minimum. Okay, 0.5 times 365, 182. So kind of 370 BCF, 370 BCF, um, on what, a minimum of 17. So that's 20%, 20% below the 5-year minimum average. And you're telling me that the share price of Diversified should be going down? I just look at the numbers. Look at the numbers, and the price drop is just an opportunity as far as and this is not advice. This is just me talking about the numbers and talking about what I see as the facts. These are just, I'm trying to present some facts as I see them. What you do with that information is entirely up to you. I couldn't give a monkeys. It's your decision. It's your this is just for entertainment. However, um, there's no logic behind this price drop, none whatsoever. It's not, on the face of it, it's not being driven by shorters. Yeah, the shorters are heading for the exits. Okay. I mean, I don't know. There's not much, probably a lot more to say. I mean, we've covered the piece around the refinancing. We've talked about how this rescheduling, or the restructuring of the debt is good. This was quite an interesting thing here, where someone said, "Oh, more debt, more problems, more negativity." Well, no, not really. Um, and this is just sort of basic mechanics of business. Okay, if I use some debt to buy assets that generate profits, and if the profits are greater than the cost of the debt, then I've increased my profits. Okay. Now, there's more to it than that, in the sense that you've got to obviously be able to make repayments, and you've got to be able to um, not run out of cash more than anything else. I mean, more businesses go bust running out of cash than they do about being unprofitable. But the point with Diversified is that it's very cash generative. The capex is not their style. I mean, obviously, the capex will be sustaining capex, stuff wears out, so they'll replace it. But we can see from 5 years of numbers that that capex number is far, far lower than, a smaller comparable company of Maverick that didn't do that strategy and didn't pursue that strategy. Now, going forwards, a diversified going to suddenly grow a love for drilling, pouring money into the ground, into the drill bit? I don't think so. I think that would just be completely not their style. But will they do a JV, a joint venture, to kind of say, look, you take the risk, we'll get X% of the upside if you find oil. Yeah, I could see that. I could see something like that being logical and what will happen. But crucially, that does not affect your cash flow. If you've got somebody else pouring the money into the ground, you're just getting the upside if they find something. Even if it's just a small percentage, it's a small percentage of no risk, a small percentage of no cash outlay. And that's always been diversified strategy. So are we saying that that's going to change? I don't think it will. I really do not think it will. Yes, they'll carry on that joint venture with the drilling partner, whoever they are. And actually, it was interesting. A final thing, well, I think possibly there might be a few things else to say, but this was a very interesting presentation from this gentleman who is as far as I understand it, these guys do sort of analytics on North American or US oil and gas, and basically his presentation was, well, you know, what what does this Maverick deal look like? Let's understand the 1.275 billion investment and its strategic advantages. How prolific is the Cherokee? And these guys do kind of like analysis, AI driven analysis of drilling results and I mean stuff like that, shall we say. um and like, just, I mean, you obviously need to just go and watch this video yourself, no novilabs.com. But just to kind of give you some what I took from it. The opinion was that it was accretive, that obviously, I mean, hopefully these things aren't sort of things that you don't already know, but let's just sort of cover what it's accretive, it's deleveraging. In other words, it was what I was talking about, that it sort of shares the debt among the Maverick shareholders. So it's deleveraging in that sense. That and again, that was sort of, I don't think people really kind of took that on board, looking at the chatter sphere. But here we've got, you're going from um, 2.9 times, and these guys are on 1.8 times. Bash it all together, and it drops to 2.5 times. So the leverage is 14% improved by the sharing of. So in other words, the debt per share drops, combined drops to $26 from sorry, yeah, this is the placing that drops it. And so it sort of shares out the debt more widely, essentially. And in that sense, then can be seen as a positive. So I sort of agree with these points. Opens the company up to a prolific exploration play. The Cherokee is still relatively understudied. Could have over 5,000 locations in it. Early results are Permian-esque. Now, let's just sort of cover. I mean, this is my interpretation of what this gentleman is saying. Basically, actually, let me just finish what the Maverick Permian asset is not in the basin proper. It doesn't compete with Delaware productivity, but it can compete with Midland type curves. So my understanding of what this gentleman is saying, which may or may not be, I think if you're from the oil industry, you'd probably understand what he's talking about far more than if you're not, without wanting to sound rude. But the gist of it is, I mean, and let's go backwards from here. He talks about these are not in the basin proper. What he talks about is that this is basically the Maverick assets. These are the these are the sort of this is the Permian Basin. And actually, if I show you, it's interesting. If I show you this slide of the this one, sorry, yeah, um, this is the same thing. This is the same thing. All of these little colourful oil rigs. I don't think they are these colours if you go and visit them in America, but uh, yeah. So anyway, these relate to the different companies. Sorry, I'm just being a bit trying to be a bit funny, but anyway, these are the assets. So some of them are over here, but these are the Permian assets. So what he talks about is that these are sort of not in the main port Permian. So you've therefore not paid Permian prices, um, but these are sort of seen as being very not very good. Is the gist of it? He sort of talks about the colors being sort of how much water to oil there is, and then how much I think this related to the colors related to sort of how much oil had been found. But he then sort of said the thing is that then when you look at like the cumulative oil, you know, you'd expect this red curve, which is Maverick, to be kind of down here somewhere, but it's not. It's up here. So it's not as prolific as the most prolific, but it's certainly not the most unprolific, if I can use that word, as you'd expect it to be. In other words, it's a lot better. Um, so this is why he says that it's, and I apologize that I'm sort of you really ought to just watch it for yourself because I'm just giving my synopsis. He then goes on and says he really likes the Cherokee. He sees this as positive. Um, that he talks about it being, potential, having very, very high potential. Obviously, this is all stuff that needs drilling out and so on and so on. Which is again, it's not DEC style, but he says, look, this is what this is what we're seeing, and this is sort of like undiscovered, but this is the productivity. And if you compare that against the Delaware and against the Midland, it compares very, very, very well. Was the sort of and again that's sort of me paraphrasing. So Cherokee is understudied, potential, could be a prolific exploration play. Um, so yeah, make your own judgments, and then sort of talks about different things as well. Yeah, as I say, it is aimed at people that understand the oil industry very deeply. Um, I'm not from the oil industry. I don't pretend to be. I just look at numbers and yeah, that's all I do, and just read a lot. And I appreciate the expertise of people like this gentleman who clearly is in this service, whatever this clearly looks like a very interesting way of analysing oil companies to kind of determine their worth. So yeah, all positive stuff. So anyway, I think that's probably we're almost at an hour. I meant to only talk for 10 minutes, and probably all of you have switched off by now anyway. So anyway, I'll conclude there. I hope that's been useful, and it really is only just covering the articles I've written and just trying to bring them together to sort of give a picture. But um, yeah, anyway, that's enough from me. And this is Oak Bloke saying cheerio for now. Cheerio. And if you want to read the Oak Bloke, it's theoakbloke.substack.com. So do subscribe. You're very welcome. Do sign up to subscribe here on YouTube if you want to. I publish things here sometimes before, so I'd recommend subscribing to both, but it's up to you. Anyway, cheerio for now. Cheerio.